Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, March 18th, 2020. It's action market's not closed, but I'm going to start it now. A few minutes. Basically, we'd have to have a pretty big reversal, and that's certainly a possibility. 3 minutes to go as I do the video. These videos are timestamped somewhere. I can't see it on here. It comes out after the video is up. I think it's on the bottom down here. Alright, so what I wanted to cover is we do have that potential bear trap scenario. I laid it out in yesterday's video, also laid it out this morning, talking about the significance of this level down here, about 69.50 we'll call it, give or take. On NQ we had 1, 2, 3, 4 distinct tags, and we took it out today, pulse of selling. But then we reversed, and now with 2 minutes to go, looks like we're going to close back above there. So this is not any type of all-in buy signal, but it does support a couple things that I'm seeing. And number one is, at least for now, and this can all change tomorrow. It could change tonight, but as of now, that's just a pretty important support level that the market is defending. In other words, I'm seeing what may be seller fatigue, and it may be a temporary thing, guys. Sometimes that happens. Sometimes you have these little consolidation periods, and then the next leg down starts. However, when you take that coupled with these strong positive divergence here on the 60-minute charts, and some other things I'm going to show you right now, it does give you the ingredients for a bounce. And if you're listening to this video and saying, Randy, you're crazy, I see the headlines. I don't look at them all. I don't bury myself in that, but I see that things are not getting any better. They're still getting worse. And like I said in one of my emails today, the whole financial system can break here if we go down much more. Fed has asked, the Treasury has asked Washington if they can backstop the money market. The money markets. Money markets are the system. Remember back in 2008, one of the money market funds broke the buck, meaning it lost its $1 share value, and there was a whole potential ripple effect because money markets are considered safe. That's what you have in I'm talking about brokerage money market. All right, so money markets, brokerage money markets are what you have in your 401k, in your IRA account, if you have a brokerage IRA, that is, or any 401k, any plan like that, and it's just where you go. It's your cash option. It may come under many different names, stable value fund, but it's basically just a mutual fund that maintains a $1 share price, or at least attempts to. And to give you capital preservation, they invest in very short-term, what they call money market instruments. Repurchase agreements, short-term, all kinds of short-term cash instruments that have very short maturities. All right, I'm getting off here, but it's just one of the things going on right now among many. And again, you're hearing more and more people stay in their homes, stores running out of food. And so you might be thinking, how can the market hold up here? And it may not, but if it does, I can tell you it's technically, certainly the setup right now. I couldn't say that at all points in times along the way down here. And again, we seem sold out. When I look at NQ, this is the fourth consecutive day. I just flipped over to a daily chart. We were on a 60-minute chart, and you can see around this level, we've had 1, 2, 3. We can lower that line. We can look at the bodies of the candles where it's closed, or we can look down here at the bottom. That's probably a good place to put a line there as well. Those recent lows. And again, we took it out today, but look, big reversal back above it. And as I said before, that is what we call a bear trap. And comes in many names: whipsaw signal, false breakdown, bear trap. They call it a bear trap because what will happen is if a lot of eyes are watching that level, which undoubtedly they were. I mean, again, this is technical analysis 101. So longs will put their stops above, figuring if we break that, there'll be a waterfall sell-off. Shorts will pile in. But then if the opposite happens, if you do break down to trigger all those, run all those stops, and then get the shorts in, they realize they're wrong here and they cover. So longs may buy back their positions, or the shorts may have to cover their shorts. All right, let's not make too much of it because everything's been whippy lately. But again, net, that is bullish. There's no other way to spin it, so I'm going to leave it at that unless that's undone. What would do that? Well, a break of today's lows. because now we've already broken the support. In fact, we really, at most should come back and test this level now if this recovery is going to hold. We really have no business going down below it, but that's always your next logical support as a previous reaction low. So that opens the door up here to that. Well, that's still R1S1, but of course, if you're swing trading now, since we came so low, and I talked about it, let's say you bought the recovery back above that 69.47 level. I can't grab right on it or I'll lose the line. I'll drag the line. But you're talking, if we get up to R1, that is a 4.95, a 5% gain. If you trade NQ futures, I don't have to tell you what that'll put in your pocket per contract. So, there's trading ops to be made. It's aggressive. And as I said earlier, if this is not your cup of tea, stay out of the market, watch, learn, and you'll get the next one. But you get chopped to pieces not knowing what you're doing in this market. So that's it. That would indicate now that's a near-term bullish event. And so that brings us up, or should bring us up to that R1S1 resistance level, about 72.93. And if and when that goes, particularly that previous reaction high, bring us up to that first target and the levels. So that's the the bullish scenario, which right now I'm leaning towards because of what happened here. And the bearish scenario would be undercut, a break back down below 62.47 or so, especially today's lows. That wouldn't be. I still don't care to short that, add swing shorts. I've made that very clear lately. We're not going to add any swing shorts right now on the indexes. I don't care if the market has 20% more downside to go. It is just not, the risk reward is not there. It's not worth it, especially with ETFs where you're stuck overnight. So the Fed or the government, they come in and announce some something to jar the markets and to really spur them up, whether it's a short ban, whether they're pumping more money into the system, whatever it does the trick. The risk of being caught on the wrong side of an opening gap that could exceed, at this point, you could be talking an 8-10% up day in the markets if that happens. We can drop 8 to 10% as well, and I know you're getting tired of hearing me say we can go down, we can go up. I'll tell you which way looks like right now. This puts the odds in the near term to more upside. And let me get away from this chart now and look at real quick, because I know a lot of you like to follow the Qs. We have QQQ 30 minute I've been going off of lately, and nothing's changed technically. It's what I wrote this morning, and really only thing that has changed, to be more accurate or more precise, we did have the false breakdown. We took out the low, that previous low. See, on QQQ you don't have all those distinct lows here that you have on the futures, and that's why I keep focusing on that chart. But what we do have is nice clean divergence. When I say clean, I'm looking at these. PPO is now making a series that has a second higher low right here, and the RSI as well, making higher lows against prices making lower lows. That's positive divergence. Given this only the 30-minute time frame, but I think it'll show through on the 60-minute as well. If I do this, yeah, there's the 60-minute chart, and that's the same divergence right there. So that's another, one of my go-to time frames. But lately I've been kind of focused on this 30. It shows a little clearer, and so we already rallied up and hit that R1S1 target right there. Shortly before the close today, futures are still going up. We're going up in after hours, and there's the trend line and T1 above. So for those of you, if you're confused as to how can the market not be plummeting with everything going on, and it still could, but here's what I wanted to get to. I talked about this earlier today. There gets to be a temporary floor in the market, whether it's permanent or temporary. It could be permanent, by the way, but we'll have to see. Because as I often say, the news and sentiment can change on a dime. It ebbs and flows. Right now, everything's doom and gloom with the coronavirus, and businesses shutting down, and grocery stores running out of food and toilet paper and other things like that. Like I said, all it takes is one good rally, and then you'll see that headlines start to kind of go the other way, talking about an abatement of cases or whatever. I'm not even going to pretend to write the news right here. But what I can tell you factually is that when you see the VIX like this at extremes, here we are back. There's the 2008 high right there. Again, I've talked about this a lot. The VIX is not a bounded indicator. There's no absolute ceiling. It can go up to whatever it needs to. Well, You know what? I take that back. 100 might be the ceiling. I don't know. I have to look at the calculations because it is a measure of put to call buying, and it's possible then maybe 100 and 0R. So I don't want to misspeak there. I'm just not certain of that. But for the most part, like I say, you do have a low end of the range over time. And what I've done here, you can see I've zoomed back to the last bear market there. And there it was. So the VIX peaked then, and I already talked about this recently. If you're new to the site, what I showed you is that peak happened back in on the week of October 24th, 2008. The stock market still had another 20+% downside from there. The stock market didn't bottom until March 6, 2009 is when the market bottomed. But the VIX topped and peaked well before that. And so what happens, so you understand the inner workings of the market, the VIX is a measure of put to call buying. So when there's excessive fear and everybody's buying puts and very few calls, find a lot of puts, it tends to put a floor in the market, just like when you have a market or a stock that has a super heavy short interest. When you have too many shorts in there, they have those shorts must cover at some point. And so, as long as a stock, it's not to say when you short a stock, you can have a high short interest and go belly up. Sometimes heavily shorted stocks are heavily shorted because their fundamental situation is precarious. I don't want to get off on a tangent there, but most of the time you'll see some of the most explosive rallies in stocks and or the stock market come from a very high short interest. When something triggers a short covering rally, and then buying begets more buying as those shorts get squeezed out, and of course then natural buyers also jump in. They're like sharks, they smell blood in the water. I'm kind of that way. I'll trade long or short, jump in on a downtrend if I think there's more downside and short away, and and likewise if I see a short covering rally, I'll jump in long, and my buying and everybody else's buying will exacerbate the move up. So that's it. I just wanted to explain a reason why you're seeing, the news is just so grim right now, but yet the market for the last couple of days here has been holding around a support level, which at this point it's safe to say at least has been a temporary bottom, and it could be more lasting. Again, it just takes a little bit of positive news flow right now, or positive sentiment to really, or could, to spark a rally. And there was the other level, the VIX, up until between the last two bear markets. So you can see kind of bear market VIX peak, bull market VIX peak. These were corrections. Kind of interesting stuff. The charts never fail to amaze me. There's just so much to see in there. So that's it. Another way to know that everyone's buying puts instead of calls is look at the put to call ratio. That's a pretty simple one. This is on stockcharts.com right here. This is an end of day chart, so it's not going to show you today's values. And I haven't updated this in a while. Only thing I've done recently, I just put on this little box down here to show you these were sell points in the market, or warning signs. You can see I have two lines on my chart. And I see this dotted or dashed red line right here. I have it around the 60, maybe 62 level, and then up here I have a green line at about the 152 or so level. And the red line tells you that is excessive put buying. When the put to call ratio is very low, you have a lot more call buying than puts. And so that means everybody's extreme bullishness. Doesn't mean that's just, you can see it's, again, we're going back for years here to the last bear market. And so when you hit that level, I showed you sometimes you'll have what I call a cluster where two or three tags in close proximity. And you can see the biggest drops throughout the bull market all came 56, 18, no, that's the last bear market, 56, 18%, 21, 10%, 16. Here, I guess that was the last update from a while ago. I was predicting a drop that never came because we had a cluster of readings. So that's a good example there. And I often say this, there's not a single indicator that's 100%. If there was, everybody would use it and everybody would be rich. So here's an example where you had excessive call buying and it really didn't result in that. So I left that on there, just kind of a reminder that, hey, sometimes these things don't pan out. But that was back in 2016. That was a Trump pump. It was really a kind of a caught the market off guard up until that point in time. The odds did not favor Donald Trump winning the election. It was early on. It was a joke that he was even running. I think it even surprised him. And so whatever. It kind of caught the market off guard. And obviously, it's very pro-business, pro stock market policies. And so that was the Trump pump, they call that. And however, once again, boom, we came down to that level right about to it earlier this year. And remember, these aren't timing signals. It just shows that excessive bullishness, and you can see what happened. Too many people were buying calls, which at the same time, it's only logical to think that too many people also, long at that time. Shorts have been blown out. That's usually what you see at these extremes. All right, that's corrections. Now let's look at the top. I don't have all the lines here and have to go like this, but what I can tell you is those extremes also coincide with the rallies. So once you hit for example, here was one extreme right here. And boom, there was a bottom in 2008. Here was, you can see this extreme hit right here, marked right around the bottom there. And you could go back in time. You can see an extreme there, and that would have come. There was a sell signal first. The extreme came right away, but that's again, it's a level that's marking where typically the extreme of put buying compared to call buying comes. That shows extreme fear, and I have it as a green line because that's typically when you want to be going long when everyone else is afraid. And you can see this is just from the other day here, this extreme. We happen to go back over a decade, and you don't even see a level that high. So I'm trying to explain to you, what could possibly put at least a near-term floor or slow down the rate of descent in the stock market despite such a negative and still deteriorating fundamental landscape. It's just this. You can't have too many people short, too many people bearish. Means that most of them have already puked up their longs, meaning sold out of their 401k, sold out of their panic, sold out of their IRA. And again, that's where you get a temporary, if not lasting, bottom. Sometimes they're lasting bottoms in the market. And one of the other indicators of many that I'll watch is the AAII bull-bear spread. I don't know if it's as accurate as it used to be in in previous years, but it's one worth watching. They poll members. You have to they're only polling members of the AAII, American Association of Individual Investors. I believe that's what the acronym stands for. And you can see when there's excessive bearishness, like here. Here, that's usually when a bottom is in. When there's excessive bullishness, that's usually when a top is in. That kind of stuff. Didn't fire the signal the top this time, and it may not signal the bottom. This is a weekly. They do it, I think, every Wednesday. The results come out, or maybe every Thursday for the previous week. So you can watch this one. But again, I already showed you that what I always say about these sentiment surveys. The reason I don't put as much stock into them because it's not necessarily people putting their money where their mouth is. In other words, let's just say I was a member of AAII and I get into the survey and I fire off that I'm very bullish. I'm going to buy stocks hand over fist. I think the market's going up from here. Well, guess what? I might change my mind. I might say I'm bullish and I expect the market to rise over where they have a period over the next 3 to 6 months, whatever the time frame is that they poll them on. I might say that that's my expectation. I might have all intentions to buy stocks, but guess what? I changed my mind. Something changed since I checked that survey, and I don't buy. So it's one thing to say you're bullish or bearish, but that's why I like to use the sentiment indicators, the put to call ratio and VIX, because that is actually where people's money is, not their mouth, not what they're talking about doing, but what they're actually doing. So that's why I believe this to be a more accurate indicator. And then finally, I'll leave it with you guys with this. I've said this often over the years. To me, I find sentiment indicators like put call ratios and completely and utterly useless when they're anywhere but at extremes. So when you're in the middle of this column, don't try to extract any useful data because there isn't any. The only useful data comes at extremes, and even then, like I showed you, it's not 100% accurate, but it's pretty darn close. Do a pretty good job. And it's also not a timing indicator because sometimes you get these clusters of extreme readings and they can be months apart. So you don't go short or long in the first extreme reading. However, you can use that in conjunction with other things that you're seeing, other technicals such as, a market or a stock being at support or resistance, maybe a breakout of a bullish or bearish chart pattern, divergences, overbought, oversold readings, and all that other stuff. So when trading, when looking for a trade or an investment, whether you're bullish or bearish, the more check marks that you can add to the box. You have a little box here, oversold, positive divergence, breakout, bullish engulfing candlestick, or other candlestick patterns. And the more of those boxes you can check for your trade, the better the chance it's going to play out. So the key is don't just use one single thing. Use it in conjunction with others. Might not have all your check boxes lined up, but the more check boxes you have, the better. And so right now there's a few check boxes that for a potential rally in the market. On the flip side, there's overwhelming and never before seen deterioration in economic fundamentals. So it's not a safe market. Even if you get a lot of check marks right now, you still have to be careful because we're not far from, I think from where this market just breaks. And what I'm talking about, I mentioned it today, the financials down another, they recovered some of the losses today, but down, it closed down 8.5%. I'm talking about XLF. That has all your too big to fail banks in there and other financial companies in there as well as banks. And the government assured us they were too big to fail, quote unquote, because they ran stress tests that they put in place since the last, financial crisis. Of course, they bailed them out. Not only they bail them out, they didn't even slap them on the wrist. They let them continue as is. Nobody went to jail, and nothing changed. They're probably bigger now than they were back then, and they're still too big to fail. And we'll just have to trust that the Fed did their job in putting together that stress test. But if they did, why are the financials down 41% off the highs? Oh, a lot more than the stock market, a lot more than QQQ. That's scary to me. So, like I said, I think here's the way I look at it. Like I said this yesterday, the market's either going to have to rally or hold up soon. Because if the financials drop another 20% or so, if they head all the way back down here, and that is a bear market target for them, they might get there soon. But if they happen to fall that fast, it's not going to be good. It's probably pricing in a bank failure or some type of financial institution failure, hedge fund blow up. Remember, the energy stocks have just been decimated. Crude's at an 18-month low. What does that do to the energy stocks? Well, there are going to be a lot of those defaulting on their debt. Who owns their debt? Well, individual investors via bonds. That's what's in JNK and LQD and those bond funds like that and other mutual funds. But the banks hold a lot of that debt too. Banks, have lines of credit, out to a lot of those companies. So obviously, they're not going to get their money unless crude did some miraculous turnaround. A lot of those companies cannot make money; they will go out of business at crude, being priced where it is now. So it's dangerous times, and like I'm showing you and trying to explain that, hey, maybe we could bounce here. So far today, we got a near-term bullish development, but don't go putting all your eggs in a QQQ or SPY long right now and throwing away the key. You want to trade around it, fine. Like I said, I showed you levels that should hold on tonight in the future, so that's where we started out. Let me see what else I need to show you. I already did an update on LQD. That's another reason that I said I'm open to a bounce in the market right here, because this stuff, there are very few coincidences in the stock market. You might say LQD has nothing to do with the stock market, but it does. The bet on this, what caused this, as I said, would be a rapid deterioration in credit quality. Whether the rating agencies have already downgraded a lot of that debt or it's yet to come, I can guarantee you most of it's yet to come. Those downgrades that I was talking about from triple B to double B or below. However, I would be surprised, not shocked, but just surprised if we didn't have a bounce, a reaction off the initial tag of this bottom of this multi-year price channel from above on the initial tag. What I mean by initial is the first time we visited since this whole year. Last time we touched it was late 2018, then back in 2013, then back 2012, 2011. So that is the most likely scenario to get a bounce. And what would cause a bounce in LQD? An abatement of the financial risks, an abatement of the risks that a lot of these companies are going to be continue to be downgraded. We don't have to have it. If we slice on right through here, it's just going to be that much more bearish, because again, this is a well-watched support level where buyers should be stepping in, and if they don't, then like I said, that's bad. Okay, quick look at the SPY S&P 500 ETF long-term chart. This is a weekly chart, holding support at a little dip below. Remember, I've had this support range here around 231 to 236, And there's your 2018 lows. It undercut those lows, but it closed back above. There's a little doji candle right there. That's our close right there. That skinny part. And like I said, undercut those 2018 lows, but so far holding above it. That's a support zone there. If it drops, if we can't hold, and we break today's lows, and we have another waterfall, or impulsive leg down, I don't see support really much. Little bit comes in there, but that's my bear market target, long-standing bear market target, before the bear market even started for the next bear market, which we're in now, around 212.52, those highs from 2015, 2016. What does that mean from today if we drop? And I would expect a lot of buyers. I think we'll see. Other than a short, outright crash in the market right now, it's just been an impulsive sell-off, and that is a possibility that could take us below there. But that's now about 11%. Earlier today, when I mentioned it, I think we're about 8%. Below that level, even a little less at the lows. And then QQQ still has a way to go. QQQ is holding up relative to the S&P 500 because, again, technology companies are not impacted as much as a lot of the brick and mortar stores that rely on foot traffic. And you're going to see more of those in the S&P 500. And so here's QQQ fighting hard to hold this 173.24-ish. I'm going to call it ish level. These are weekly charts. You can see the weekly candles move through, but that's the support, and so far it's continues to hold that support pretty much all week. That's the same. We've been testing around that level all week. So far, and even Friday. And there it is. Next stop down here. I don't have, not to say there isn't any support, because there is a minor support level right here. I can see some support from back 2018, early and late 2018 coming into play. I'm going to color that line down a little bit just to show you it's not as significant, but it is a potential support level, so it's worth watching. And then 143.51 would be the lows back from 2018. So again, to kind of put it in perspective, this is where the S&P 500 has gone back down to its 2018 lows right there from December 2018, and QQQ is still comfortably above there now. So that's it. I could talk on this stuff all day and all night. I love it, but I'll probably bore you to tears. 27-minute video, so we'll cut it short here. You know the levels to watch. You know the risks there, and you also know the the risk of being short. Should these 60 and 30-minute divergences play out for more upside? Like I said, we already pretty much hit that R1, but we're still a little shy of this T1 target. Remember, we hit T1. The reason QQQ, and it did reverse, almost hit it, but I told you yesterday I had a first target here on NQ when I was looking for a bounce, and we got that. So we got the minimum target of the bounce I was positioned for and looking for yesterday. That was that bounce up to T1, and that's when QQQ reversed. And so right now, as I do the video, and I'm going to wrap it up here, remember, R1S1. It was resistance yesterday. We popped it. That was a catalyst for move up to T1. We came back down. We tested all day, all afternoon since then, and then finally late in the session we broke it. And support, once broken, becomes resistance. You can see we back tested. You zoom in nice and tight. I sometimes forget we're on. You guys are watching this on YouTube. There it is. Once we broke it. Came in, broken support becomes resistance, back test, fail. Another run at it, fail. Back down to the recent lows, a more important level that I covered earlier. This is again like one of the most important levels I'm looking at in the market right now, about 69.50 or so on NQ. A lot of reactions there in today's whipsaw signal or false breakdown. And then so that was it. We broke it. We went down to that level, hit it, popped right back up. You can see this little game of ping pong here. That's how it works. So we're ping ponging between support and resistance now. If the futures can pop that level tonight or tomorrow, then the next logical target is back to that T1 level again, 75.57. And potentially, if it can take out the trend line, then you're looking at T1 and T3, which would be a considerable rally especially from where we're at now. That would be all the way up to T3. I think that was at 80.33, or did I have that fib there? Either way, we'll call it 11-12% if it gets there. But if we get to T1, you're talking about another 5, about 5% from where we're at now. And then the trend line comes right in with T1. That's why I think there's a decent shot that it can be hit. We still haven't touched that trend line since back here. All right, let's wrap it up. Get this video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.